Ethan sees a stock jump 40% in a few weeks and immediately wants to buy it. Ryan sees the same chart and asks, "Why is it going up?" Oliver looks at the exact same stock and asks a completely different question. "How much of the company am I actually paying for at this price?" That difference is incredibly important because a stock becoming more expensive does not automatically mean the company has become a better investment. Imagine all three characters are looking at a fictional company called NovaTech. A month ago, one share cost $50. Now it costs $70. Ethan sees the green chart and thinks he's watching a successful company. His reasoning is simple. If everyone is buying it, there must be a reason. And if it keeps going up, I don't want to miss it. So he buys. Ryan doesn't buy yet. He wants to know what changed. Did NovaTech's sales increase? Did profits increase? Did the company release something genuinely important? Did investors discover new information about its future? Or did the price simply rise because more people suddenly became excited about the stock? Then there's Oliver. Oliver knows that buying a stock means buying a piece of a company. So he stops looking at the $70 price tag and starts looking at the company behind it. Suppose NovaTech has 100 million shares outstanding. At $50 per share, the company is valued by the market at roughly $5 billion. At $70 per share, that same company is now valued at roughly $7 billion. Nothing about that calculation says NovaTech is automatically better. The market is simply assigning a higher price to the company. And that's the first concept you need to understand. A stock price tells you what one share costs. It does not tell you whether that share is cheap or expensive relative to the business. Think about buying a house. If someone tells you a house costs $500,000, you don't immediately know whether it's a bargain. You need to know where it is, how big it is, its condition, and what comparable houses are selling for. Stocks work similarly. A $20 stock isn't automatically cheap. A $200 stock isn't automatically expensive. The actual question is, what are you getting for the price you're paying? Ethan is focused on the chart. Ryan is focused on what caused the move. Oliver is focused on the relationship between the company's value and its price. And before any of them buys NovaTech, they need to figure out whether that 40% rise represents a genuinely better business or simply a much more expensive stock. Now, Ethan owns NovaTech at $70 per share, and for a few days it keeps going up. $72, $76, $81. Ethan feels like a genius, but Ryan is still asking the same question. What actually changed? So he starts comparing the company before the price increase with the company after it. And this is where the story gets interesting. Suppose NovaTech was earning $200 million a year when its market value was $5 billion. Investors were effectively valuing the company at 25 times its annual earnings. Now imagine the share price jumps 40%, taking the company's market value from $5 billion to $7 billion. But NovaTech's earnings haven't changed. They're still making $200 million. The business is essentially the same. The price isn't. Now investors are valuing the company at 35 times its earnings. Ryan realizes something important. The company didn't necessarily become 40% better. Investors simply became willing to pay 40% more for it. That can happen for all kinds of reasons. Maybe investors suddenly become excited about the company's future. Maybe there's positive news. Maybe an industry is becoming fashionable. Maybe people simply believe other investors will keep buying, and that last one can create a dangerous cycle. The price rises. People see the rising price. More people buy because they don't want to miss out. That pushes the price higher. Then even more people see the chart and think, everyone else is making money. I should get in too. Suddenly, the stock's recent performance becomes the reason people are buying it. Ethan is caught in exactly this cycle. He isn't thinking about what NovaTech could realistically earn. He's thinking about what the stock has already done. Ryan sees the difference. He understands that past price movement is not the same thing as future value. A stock that has risen 40% can continue rising. It can also fall. The 40% increase alone doesn't tell you which one will happen. Oliver takes the analysis one step further. He looks at what investors are expecting from NovaTech. If the company is valued at $7 billion Investors may already be pricing in significant future growth. That means NovaTech doesn't simply need to be a good company. It needs to perform well enough to justify the price investors are currently paying. That's a much higher standard. And this is one of the most important ideas in investing. A great company can still be a bad investment if you pay too much for it. Imagine someone offers you a brand new laptop for $500. You might think that's a great deal. Then they tell you the exact same laptop normally sells for $300. Suddenly, your opinion changes. The laptop didn't become worse. You simply learned that the price wasn't as attractive as you thought. Stocks work the same way. So Ethan has been looking at the question, is this a good company? Ryan is asking, what is the market expecting from this company? And Oliver is asking, is the current price reasonable compared with those expectations? Those are three completely different questions. And if you're only asking the first one, you could still end up paying far too much. Then NovaTech announces its next earnings report. The numbers are good, revenue is growing, profits are up. The company is still doing exactly what investors wanted. Ethan thinks the stock should keep climbing. Instead, it drops 18% in one day. He is completely confused. How can a good company lose 18% when its results were good? This is where Ryan finally sees what Oliver was looking at from the beginning. The market wasn't asking, is NovaTech good? It was asking, is NovaTech good enough to justify the price investors already paid for it? And those are completely different questions. Imagine investors had expected NovaTech to increase its profits by 30%. The company reports profit growth of 15%. That sounds impressive, but it is only half of what the market was expecting. So investors start lowering their expectations. The company didn't suddenly become terrible. The expectations became too high. And that can cause a stock price to fall even when the underlying business is still doing reasonably well. Ethan learns an important lesson here. He bought NovaTech because the stock had already gone up, but that rising price was partly based on expectations about the future. Once those expectations change, the price changed too. Ryan takes this a step further. He realizes that before buying a stock, he needs to understand what the market is already expecting. If everyone already expects spectacular growth may not be enough. The company might need to outperform those expectations to keep pushing the stock higher. Oliver isn't trying to predict exactly what the stock will do next. Instead, he is asking whether the current price makes sense based on the company's financial performance and the growth investors are expecting. And this gives the three characters three completely different ways of looking at the same stock. Ethan looks at momentum, Ryan looks at expectations, Oliver looks at valuation. None of those automatically tells you whether a stock will rise tomorrow, but they help you understand what you're actually buying. And there's another trap Ethan now understands. A stock can be rising because investors are becoming more optimistic. That optimism can push the valuation higher, but eventually the company has to deliver results that justify those expectations. Otherwise, investors may decide they were paying too much. That's why simply saying the stock is going up tells you almost nothing about whether you should buy it. You need to know what is driving the increase. Is the company earning more? Is its future expected to be much stronger? Has something fundamentally changed? Or are people simply buying because the price has been rising? Because if the only reason you can give for buying a stock is everyone else is making money on it, you're not really analyzing the company. You're chasing the chart. And charts can change direction a lot faster than your confidence can. By now, Ethan understands why he made the wrong decision. He wasn't necessarily wrong about NovaTech being a good company. He was wrong about what that meant. A good company can have a stock that is too expensive. A bad company can have a stock that is cheap. And a stock that has already risen dramatically can still rise further or suddenly fall. So before Ethan buys another stock simply because the chart is green, he starts using a different process. First he asks, what actually changed about the business? If revenue, profits, customers, products, or future prospects have genuinely improved, there may be a fundamental reason investors are willing to pay more. Then he asks, what is the market already expecting? If investors already expect enormous growth, the company may need to outperform those expectations to justify an even higher price. Then comes the question Oliver kept asking, what am I paying for that growth? That's where valuation becomes important. You don't need to become a professional analyst to understand the basic idea. You're trying to compare the price of the stock with what the business is actually producing and what investors reasonably expect it to produce in the future. Ryan now sees why the original $50 versus $70 comparison was misleading. The important question wasn't, did the stock go up? It was, did the company's value and future prospects improve enough to justify the higher price? Sometimes the answer will be yes. Sometimes it will be no. And sometimes you simply won't know. That's completely fine. Not buying a stock because you don't understand, it is very different from missing an opportunity. You don't need to own every stock that goes up. Ethan finally understands this after watching NovaTech fall. He bought because he was afraid of missing out. Oliver never bought it at $70 because he couldn't justify the valuation. Ryan waited until he understood what was driving the price. None of them could predict exactly what would happen next. That's not the point. The point is that a stock chart is telling you what has happened to the price. It isn't automatically telling you what the stock is worth. So the next time you see a stock that has jumped 40%, don't immediately think, I missed it. Stop. Look at the company. Look at what changed. Look at what investors expect. Look at the valuation. And then ask the question that matters. Am I buying a better business? Or am I simply paying a higher price? Because sometimes a rising stock is an opportunity, and sometimes it's just an expensive stock that has become even more expensive.